All right, this is Ubaid on behalf of V Electronics, and in this video, we're going to be talking about the interest rate risk as well as rate of return. Okay, now when it comes to your rate of return, unlike the yield, gives you an idea as to how lucrative the investment is. Okay, how much cash flow you will get from that investment. Okay, how much money you will make from that investment. Okay, that has to do with rate of return. When you invest in stocks, for example, or ETFs, you look at the rate of return for your principal. If you invested $1,000, what will you get at the end of the year? Okay, that's your rate of return. And when it comes to bonds, especially coupon bonds, rate of return can be used to measure how lucrative these coupon bonds are. Okay, so say for example, okay, if you have a coupon bond with a coupon rate of 8%. Okay, and the face value, this is $100. All right, now we know that the interest rate when you bought the coupons is 8%. All right, now if this interest rate goes up, okay, we talked about this in the last video. If the interest rate goes up, okay, what's going to happen is that this bond will become less valuable. Okay, because all of a sudden, okay, people are willing to pay more for this, well, less for this bond and more for the bonds with higher interest rates. Okay, because the market value, the going rate, the market rate has gone up. So as a result of which, interest rates are inversely proportional. Okay, so they are inversely proportional. Okay, to let's say your price. Okay, so price would be your selling price, okay, of the bond. Okay, so if the interest rates go up, we know the market rates have gone up, the going rates went up, as a result of which your bond, your coupon bond, is less valuable than the ones in the market right now. Okay, the ones with the higher interest rates because they pay more. As a result of which, okay, the price of your coupon bond will go down. As a result of which, your interest rate is inversely proportional to the price of the coupon bond. Okay, which basically means as interest rates go up, the price of the bond goes down. Okay, which means you have to sell that bond for a discounted price. Okay, if the bond's value is $100, it may be sold at $98. It may be sold at $90. It may be sold at $80. Okay, however, if the interest rates go down, we know the market going rate goes down. Okay, because of whatever economic condition in your country. Okay, you have interest rates going down. Okay, what's going to happen is, okay, the price of your bond will go up because now all of a sudden your coupon bond pays more than the going rate. Okay, so if your price was $100, you can expect to sell your coupon bond for a premium, let's say $110. All right, and we can write this in a form of equation to understand how this works. Okay, so to do this, you will need to figure out the rate of return or return on your investment. Okay, and for this return, for the return on your investment relevant to coupon bonds, okay, you will need to know your coupon rate. So C stands for coupon rate. Okay, which may be the interest rate when you bought the coupon bond. Okay, and then you have your PT0. Okay, this is your purchase price. Okay, or the price of the bond or coupon bond when you bought the coupon bonds. Okay, so this is purchase price or face value. Okay, you also have PT1. This is your sale price. All right, and finally you have your C, which is your coupon rate. Okay, now to figure out your rate of return, you'll simply use this formula over here. Rate of return equals C, which is coupon rate, plus, okay, PT1 minus PT0. Okay, all over PT0. Okay, so say for example your coupon rate is 5%. So you're going to put 5 over here. Okay, so this will be 5 plus, let's say your selling price was 105. So you sold your coupon bonds at a premium, which is 105. So 105 minus 100. Okay, and 100 in this case, this is your purchase price. So this was the face value of your coupon bond when you bought the coupon bonds. All divided by your face value, which is 100 one more time. Okay, so now if you want to solve this equation over here, okay, this will be 5 plus 105 minus 100. This is 5. All divided by 100. So this will be 10 divided by 100, or 0.10, or 10%. Okay, so basically what you're saying is the rate of return on your coupon bonds today is 10%. When you sold the bonds, the year in which you sold the bonds, the rate of return was 10%. Okay, so this is what you got out of your coupon bonds. You got 10% on your investment. Okay, now we can use another example. Okay, so let's say your rate of return, okay, this is no longer, okay, or coupon rate rather, is no longer 5%. Okay, let's say the coupon rate is 10%. Well, you know what? Let's keep it 5%. So let's keep it 5%. So let's say your coupon rate is 5%. Okay, and your purchase price, this is 100. Okay, and your sale price, okay, when you sell the coupon bonds, let's say this is 90 rather than 110 or 120. So you sold it at a discount. So in this case, you're going to figure out the rate of return. So rate of return, again, same formula. You have C, which is 5. Okay, plus, okay, you're going to have your PT1, which is, okay, 90, minus 100. All right, all divided by PT0, which is 100. Okay, so all of a sudden now, this is 5 plus 90 minus 100. This is negative 10. Okay, negative 10 divided by 100. All right, so this will be 5 minus 10, which is negative 5 divided by 100. So if you do the math, this will be negative 5. Negative 5 divided by 100. Okay, or negative 5%. Okay, so this will be 5%. Negative 5%. So rather than getting a positive rate of return, rather than making money out of your investment, you're now losing money, as a result of which your rate of return on your investment is negative 5%. Okay, this is when you sold your coupon bonds at a discounted price. All right, so again, as the interest rates go up, okay, you may end up selling your coupon bond at a discounted price, as a result of which the rate of return on those coupon bonds will be less than when the interest rates go down, when the going or market rates go down, as a result of which you end up selling your coupon bonds at a premium price, okay, more than the face value. All right, so that will be it for this video. On behalf of V Electronics, this is Obaid. Have yourself a great day.